What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello, welcome back to What's Making Headlines. It's Annie, Ben and Charlie with you today, unpacking the news of the week. Charlie, how's your week been?
It's been good. It's picked up a bit. And we're hearing from everyone this week. So
yeah, I think after the stress of end of financial year, the first week of July was dead silent.
Yeah.
Well, even the first 10 days, actually. So glad that things are starting to
yes,
roll back up again.
Very
because
encouraging.
It's hard as journalists to try and get people to talk to you for news when things are quiet. We're like, I know you're
when
busy,
objectively
but
nothing is happening. Yeah,
like we're having to make things up.
Yeah.
No, we're not. Ben, how are you going? How was your week?
Yeah, good. As you said, things are getting a little bit busier now, which is, I guess to be expected. But good week overall, I think.
Good week overall. And I think also at the moment we've got lots of events going on. I know next week we've got the MFAA National Conference, which we'll be going down for. I'm actually hosting a panel on that for the future of broking, which will be really interesting.
Awesome.
Talking to brokers, lenders, and a woman from the association in Canada talking about how Canadian broking works and what sort of things they're seeing over there that we can learn from. It'll be super interesting. That's next week. But this week, looking at all the news that's been going on, again, masses happening. So I think some of the big things we've been seeing from the associations this week have been kind of feedback to government consultations or inquiries. Again, there had been a whole heap of these towards the end of financial year. And I think one of the big stories that got lots of brokers coming to the advisor this week and commenting was around the FBAA's comments on clawback. Now, Charlie, you wrote the story for us, hearing from some of the probably the first official comments from Leo still coming through. So we did interview him last week to find out what he was sort of doing with the FBAA in his first initial priorities. But this is really kind of the first time we're hearing from his CEO having an opinion on what's been happening. What was he saying and what's the go?
So this was a submission from the FBAA to Treasury's June consultation on unfair trading practices and protections for small businesses and franchisees. So in the submission, they unpacked a number of what they deemed, quote unquote, unfair and anti-competitive behaviour by lenders. And one in which there was a lot of detail about was clawbacks. And we know this topic comes up very frequently. It's really controversial.
Well, controversial for the lenders. I don't think it's particularly controversial for brokers. We're like, get rid of it.
Yeah, well, it generates, I think, kind of disagreement among lenders and brokers.
Yep.
And so the FBAA kind of outlined in their submission that despite being originally kind of intended to prevent brokers from committing misconduct, it's now become out of brokers' control in many instances, whether it be a borrower chooses to sell or refinance or that kind of thing. The majority of the time, a broker can't control when the commission's going to be kind of taken away from them.
Yep.
And so the FBAA took issue with that, especially in instances where lenders justified clawbacks on the basis of their internal cost calculations. And he said some institutions, quote, base clawback calculation around the notion of cost recovery, and he labelled this approach, quote, unfair and inequitable.
Yeah, because I think a lot of the time, obviously, the lenders don't really make a massive amount of money until kind of after a couple of years into the loan. And so the argument, I think, here is saying, well, if the loan refinances within the first 24 months, we're not making the money that we were expecting to, so therefore we need to recover the cost because we're not making any money, which kind of does feel unfair because you're like, well, this is the remuneration for the broker. So
exactly.
It shouldn't be about we haven't made enough profit.
No.
But it is, and I think this is the whole point.
Yeah, exactly. Thinking that that's coming into view and lenders are taking that into consideration, which they disagree with.
Yeah.
And the submission touched on a number of other things as well. They criticised net offset arrangements, under which commissions are calculated on the loan balance after offset funds are taken into account. And
that was a Royal Commission change, I think. Yeah,
yes.
Net offset. And
the association described the manner in which these provisions were being implemented in practice as shocking, quote unquote. Shocking. And also linking slow commission payments to wider kind of policy settings on small business cash flow, and basically saying that the length of these payments ran counter to basically government expectations and that kind of thing.
But there's always a counter argument as well of sort of saying be careful what you wish for, because if you remove clawback, then the lenders might look to change upfront or trail or change the remuneration structure more broadly, which has always been the criticism and the concern, I think, when we talk about clawbacks and remuneration. But this is an interesting inquiry that was held. It kind of snuck through there because it was quite a short consultation period. And also it was during the whole kind of budget fallout, all of the LRBA things. So it wasn't something we were overly focused on. It's actually unfair trading practices for small businesses. So we kind of
got a little bit overshadowed.
It's more focusing on like things like 7-Eleven franchisees and kind of, the big franchise groups. But this is obviously does also impact brokers. So it's good to see FBAA put in their submission and give us some commentary on what they think should be happening, and obviously fighting the fight for clawback, which the FBAA has been doing for years. Really interesting to see this comments from Leo. Ben, when you were sort of looking at the stories and what the broker commentary has been, has there been anything that's sort of been really jumping out at you as to the overarching themes or arguments?
The clawback one is always very interesting for our readers. That was the one that sort of stuck out. I suppose in the FBAA submission, the other interesting thing was their note on introducers and sort of the accreditation cancellations, which they also touched on, talking about introducer and referral programs, which we've talked about a lot, and sort of contrasting what the obligations are on licensed credit businesses with payments made to unqualified referrers, such as accountants and lawyers. It made some interesting points that we've already touched on before, but it's interesting to sort of see that brought up and put before Treasury, I suppose.
Yeah, and I think that's it as well. Like, a lot of the time, as we sort of said there, when we looked at the unfair trading practices on small businesses, a lot of it is focused not on this kind of relationship. It's more on like retail or on kind of, the sort of consumer market. So seeing B2B relationships and how that works, for example, broking and lending, I think that's really interesting, seeing the FBAA kind of putting out a submission for brokers saying the lenders have unfair trading practices and they should be looked at. I mean, again, and there's lots of different things that we've heard from other inquiries and other associations and other groups that they would like to see fixed from the lenders, like discharges. We always hear the MFAA talk about that, wanting to implement the 10-day discharge period, which has been something recommended years and years and years ago in the...
Hasn't been picked up by the government.
Hasn't been... Well, they kind of said they were going to do it, but they never actually have done anything about it. So... Yeah, lots to be improved, it seems, in the lending landscape. But talking about the associations, we did also hear from the MFAA this week as well, and one of their submissions to a government inquiry or consultation. What was this on?
This was interesting. This, as you said, was from the MFAA in a consultation process on the government's current development of Commonwealth Verifiable Credentials Trust Framework, which...
Mouthful.
I know, which is basically the Commonwealth is conducting a consultation on verifiable credential policy, and the MFAA is arguing that due to how deeply embedded brokers are in identity and data processes across home and business lending, that lending should be placed at the forefront of this rollout and trial. To begin with, and basically the MFAA is linking these digital reforms to existing digital reforms that are already in effect, like the CDR, and they think that it would, speed up, speed up processes.
What exactly is it they want then? So it's about identity when you talk about verifying things.
Yeah. So they're basically. It's basically another form of kind of official identity, like digital official identity.
So it's talking about having a better consolidated and centralized digital identity verification check.
Yeah,
right.
Which they think could help tackle fraud and onboarding and identity checks and that kind of thing as well. And so making them clearer and less kind of ambiguous. And so the MFAA in the submission has said the new infrastructure, quote unquote, presents a significant opportunity for verifiable credentials VCs and digital ID to improve customer onboarding, identity verification, reduce fraud and impersonation scams, and also reduce reliance on insecure document sharing, screen scraping, and improve efficiency across the home lending process, support broader adoption of CDR and digital transactions, which we've seen come up a lot recently about digitizing some of these legacy checks, both in lending and broking as well.
Yeah.
Which is, I think, why the MFAA is seizing this as an opportunity to further that.
Yeah, and again, I think that the associations do a great job in looking at these consultations and inquiries and kind of making it relevant for the broking industry in times where, they might not be an obvious choice for some of these things. Because, so they were sort of talking about looking at the Commonwealth Verifiable Credentials Trust Framework. A lot of the time, like the lenders might be providing some information on this, but, the brokers are kind of reliant on the associations and the aggregators actually putting forward this information. So it's really great to see MFAA doing that and, really calling on the government to make lending and property transactions a priority use case so that we can try and stamp out fraud and have an easier and more systemized way of identifying people's information.
Yeah.
And identity.
100%.
Speaking of compliance and regulation, we did hear from ASIC as well this week.
Yep.
Another round of levy estimates coming out. Always a joy whenever we get these stories coming out from the different regulators, because we've had, AFCA and APRA and ASIC and the CSLR. There's always different levies coming out. And we've had the latest CRIS, or the Cost Recovery Implementation Statement, come out from ASIC for the year just gone, the financial year just gone. And again, this is always a kind of delayed approach, because they kind of put out an estimate and then they come back and don't invoice until January, and then they go, well, actually, all of those estimates were completely wrong. So everything that you budgeted for, throw that out the window, because we have a whole new estimate this time round. So for FY26, looking back at FY26, how much do they expect to recoup from the broker channel, and what was the difference?
So under the draft numbers, ASIC expects to recover 9.74 million from credit intermediary subsector in 2025-26. So this is up from the actual costs of 8.28 million the previous year.
Yeah.
So it's an increase of 17% or 1.44 million. And this will be across the 4,097 license holding entities in the credit intermediary subsector. And so how this translates to the invoice is you've got that minimum levy of $1,000 for each credit intermediary for the
credit rep.
Yep, for the 2025-26 year. But there'll also be a per representative charge. So it was $89 on the 24-25 year. It's now going to be $120 on 25-26.
It's quite a big cost for aggregators then, if they've got thousands of credit reps underneath them, to see that go up 20-something%.
Yeah, it's a steep increase, and as you said, it's frustrating if you've budgeted on the final numbers, in which that's what they're labelled, and then you see the estimates come out, and it's an increase of $40 per rep. Like you said, like an aggregator with a large number of credit reps is going to feel the sharpest increase for sure. Yeah,
and again, as we say, we don't get the invoices for this until January. So by the time the invoices come out and the final levies are all totted up, it might be completely different all over again. So and they often don't address, what the difference is. Like in this one for the estimate, they kind of say, oh, it's the increase over FY25 to FY26 is because of more enforcement action, more supervision. We haven't seen a massive amount of broker credit intermediary prosecutions this year from ASIC.
No.
The ones that I think in the credit space we have seen quite a bit are on, things like car finance. We saw that. There was some looking at car dealers and credit intermediaries for that.
Information gathering mission on the best interest duty as well.
That too, which we still haven't seen the final outcome of.
Ongoing inquiry.
Yeah, so that as well. And I imagine then if that's ongoing, next year's ASIC levy will be even higher, because there'll be all of the sort of action taken off the back of the finalised report. So
been in train for like a year and a half.
Yeah, so there is a bit to go through there, and I think, as I say, aggregators will be kind of looking now at doing all their sums and thinking, oh great, here's another thing we have to budget for, and of course that does potentially impact broker charges, because it may mean the cost of your aggregation membership will go up to cover it.
Yeah,
never a good thing.
No.
And also it was kind of overarching all of the kind of categories that ASIC budgets for, whether it be like supervision or surveillance or enforcement. And then in addition to the direct costs, you've also got like shared services and strategy and that kind of thing. Everything went up. So it wasn't just exclusive to, say, enforcement action or supervision. It was across the board. And by steep margins as well.
And of course, we're focusing in on the credit intermediation section, but if you're interested in all the rest of the levies, then thank goodness you're not in the financial planning sector, because again, the levies there massively up, as they have been for the compensation scheme of last resort and for the Australian Financial Complaints Authority, obviously with all of the fallout from the advice problems or the insolvencies and collapses in the financial advice section. All of that kind of area has been having a huge amount of cost increases. So
it went up by about 100 million across the board.
Yeah.
So it's a pretty steep increase year on year. Although I read through a lot of the previous stories you've written, and a 19% lift across the entire industry funding take was lower than previous years.
Yeah.
So it has been steeper.
Yeah. Well, we have had things like the Royal Commission before, so I think that will never be topped. But I think like I've been reading some other media outlets who've got raising some good questions, which is, well, when ASIC takes these court actions, enforcement actions to court, and then they actually get their costs recovered, why don't we get a refund? Because they're having their costs already recovered. Like, what else are we paying for if it's not for this sort of action? And obviously there are other costs at ASIC that are involved, like paying people's wages and things like that. But you'd think that would be covered by the government. So I think a lot of it is saying, well, surely they're recovering costs from their court actions. Why don't we get some of that money back? Or a reduction in the levies? I think that's a good point.
Yeah, very good point. Very, very good point.
We'll take a quick break here. When we come back, we'll be looking at some political chatter and what's been happening with the different parties. We'll get into that just after this message. So we've been following, we don't tend to talk about other political parties other than the party in power and the opposition, because of course they're the two major ones. But increasingly there has been chatter about what the other parties are doing that are growing in popularity and dominance, and looking at, well, what are their policies and what are their beliefs in different things, because of course they may be gaining more power. I think this is a really interesting story. One Nation coming into our headlines this week, which we very, very rarely write about. Sometimes about the Greens when they're talking about housing, or if they're doing something in the Senate. Very rarely talking about One Nation. Ben, what were they been up to?
Yeah, so we put this one out earlier this week. We found out that One Nation has a proposal, or have sort of unveiled plans to create a people's bank that would offer 30-year fixed-term home loans at 5%. And they also mentioned some stuff about giving the RBA greater license to pressure governments on spending as well. But basically the long and short of it would be that under this plan, One Nation would scrap the $11.5 billion Housing Australian Future Fund and redirect that into a new lending ops institution that sort of operates out of Australia Post outlets and provides long-term fixed mortgages on a 5% rate. So I'm sure a lot of people would love to snap
That sounds great in theory.
that offer up. There has been quite a lot of as if anyone's read that story about it, there has been a lot of sort of criticism of the feasibility of that scheme. I think you had some interesting quotes from UNSW economics professor Richard Holden, who said that could require anywhere from 10 to 50 times its proposed $11.5 billion funding envelope.
I mean, that's very expensive
demand.
to cover.
You'd be generating you'd imagine that it would generate a significant amount of demand if you're offering at a percentage and a half under a market rate.
I wouldn't want to fix for 30 years because I get it in different countries. The UK, we have long fixed rates. In the Netherlands, they have long fixed rates. In America, even, they have long fixed rates.
Yeah, US.
So I feel like, but they're very different markets and they have very different kind of operations of the mortgage market. Australia moves very, very quickly because we're mostly a variable rate market and we have, very short loan periods because we refinance and reprice very frequently. But I think for me, I just can't imagine having not having the benefit of changing cycles or not having the benefit of being able to break your term. I wonder what the fee would be if you broke out early from that fixed rate loan, for example, at a 5% rate. Plus, I can't imagine many banks will really want to do that either because it's where there's not a lot of fat in that. They'll probably want to have a bit more flexibility to set their own rate. So I'm not sure about this.
The break cost would be huge though. If you've got a $1.5 million loan, and you're 8 years into it or something, or 5 years into it, and you choose to refinance, that's a big chunk of money.
You think so, yeah.
That the government will be forced to outlay. So, anyway, I think it's been downgraded now by the Treasury spokesperson, Barnaby Joyce, come out and basically said, well, look, we're still discussing it. It's not completely official, but then you had Pauline Hanson come out and say it is official. The $11.5 billion envelope is our costing for that policy. So there's a bit of conflicting messaging coming, I think.
And I think this is always the beauty when you're not in power, is that you can say things and come out with these policies and come out with things, and you don't really have to have the detail behind it. I mean, we often argue that as well with the coalition, is often when they sort of say what they're going to do, you're like, can we have more detail? Like, how exactly are you going to do this? Because they kind of have these grand plans, and you're like, well, because they're in opposition, they don't have to.
Yeah.
And a lot of the time, their argument is, oh, we don't have the resources to be able to kind of pull this into a proper policy. But yes, I would like to see more detail of how that actually costs.
Yeah.
What that actually costs, because yikes.
Yeah, I think so too. But it's certainly re-energised debate.
And it's populist,
on
isn't
the
it?
topic.
I mean, every mum and dad out there would be like, a 30-year loan at 5% would be fabulous. I would take that in a heartbeat. But feasibly, I just don't know how that would work.
It's been tried before, my understanding, at a state level a couple of decades ago. And due to market changes, and we're talking about those break fees, the kind of schemes are unprepared for that, and so they basically collapse. And there's not enough kind of equity buffer there to support them. So yeah, it's an interesting debate. I enjoyed writing it, and a lot of interesting commentary on what's actually involved behind the scenes to hold up a loan,
The other thing that we've been talking about this week, which is actually quite a big news story, is non-banks now having to share product data in open banking, which is exciting. So that happened this week.
Yep.
We've known it's been coming for a while, but I think this is the first time we've actually had it implemented, and having to see the non-banks share product data. So things like interest rates or limits and offsets, all the stuff that you already get as a broker through open banking for the banks, now having to be available and shared by the non-banks. It will take a while before we get more data like consumer data. I think it's not till the end of the year that happens for the non-banks, but this is the first step. Charlie, what were they telling you?
Well, the non-banks that I spoke to welcomed the change.
Oh, that's good then.
Yeah, it basically said that, reflects the maturity of our industry, that there's more transparency and across the board kind of data sharing, and that the system is interlinked, and that there's, I guess, more information there to put together a more informed view of what's actually happening beneath the surface. And I spoke to Bluestone Home Loans Chief Commercial Officer Tony McRae, who basically said the expansion reflected, a pretty significant change in how the sector, managed and used data. He said, quote unquote, the extension of the CDR to non-banks signals a sector that has matured along with the data behind it. And they basically said that, the CDR only makes sense to incorporate non-banks into the CDR, and gives consumers eventually, like you said, later in the year, more control and clearer visibility of actually what's happening with their financial data and that kind of thing as well. So, yeah, it's clearly part of this push to, better interlink the entire chain and create a bit more informed view of things as well for both consumers, lenders, and brokers.
And I think the key question here is if it works, because as we know from the banking industry, there's been many, many, many problems with the data that's been pulling through in open banking data. It's either inaccurate or it's wrong. They have come actually a really long way in fixing that. I think, when we first sort of started seeing the data sharing from the banks a few years back, it was just really incomprehensible. People not understanding what they were actually meant to be putting in the different fields, and not having like a glossary, I suppose, almost of what the terms were. So things were just coming in wrong and broken. They have come a long way in that, but still not having a massive reliance and accuracy level. I think one of our fintech partners that we talk to quite a lot for our broking events, Stride, does a lot in the consumer data right, and they're always saying, because they're reliant on open banking data, they're like, there are so many problems. So they're constantly having to go back to the banks and be like, did you know this doesn't work, or this is broken, or this isn't quite right. So there's a lot of fascinating insights in there from them as well. But it is good to see non-banks come in. I think the main worry they have, though, is because obviously as a non-bank, they have a huge array of products. So this is going to be a massive undertaking for them, unlike the banks, which might have, obviously a lot of products anyway, non-banks will have probably even more, because they're doing some of the things that the banks don't want to do as well.
Exactly.
So I think about things like, historically has been Resi SMSF, although that's obviously not really so much a problem anymore.
No.
But then also looking at, reverse mortgages or looking at personal loans and some of the stuff that maybe some of the banks don't do. So they have a lot more product out there to provide data for.
Yeah.
And then plus, as we say, there's always intricacies as well around who's using a non-bank and what kind of things they have on their credit file that might look slightly different to a kind of a bank customer. So a bit more intricacy. And I think they're slightly concerned about the time and effort it's going to take to actually get all this data done and through.
Yeah, probably automate it to an extent. But I think the ACCC has said they're going to be both lenient in terms of administering the data sharing operation. That it's a massive undertaking, obviously, but also they're releasing guides and handbooks to the non-lenders as to as you said, what to input and how to make it decipherable for consumers, so it's not gobbledygook.
Yeah, I mean, the consumer angle is, I think, slightly different. Like, a lot of consumers now are probably used to doing it. We know, like, a lot of brokers are having a lot more cut through and being able to tell their clients what the benefits are of sharing their open banking data with them and not having to constantly go back and ask for new pay slips or find out what their limits and rates are. But I think, in terms of the actual product data itself, that's where, if you don't have a massive tech team available to you as a non-bank lender, it's going to be a lot of effort and time for small tech teams to actually go through and do. So hopefully they've been adequately prepared because they've had a long time to think about it.
Yeah, or maybe they should. The big tech team. Yes.
We'll take a quick break here. When we come back, we'll be looking at some of the new rate forecasts as well. We've got another few weeks before we get the next rate decision, but already we're seeing some movement from the forecasts from the majors, and we'll get into that just after this message. So I feel like we can't really go a week without having talked about a change in a major bank rate forecast. It is very, very fast moving. So anytime anything happens, if we get new economic data from the ABS or from APRA, looking at some of the things that have been happening, we nearly always get a reaction from the banks. And half of the time, I'd say at least one of them will change their forecast based on what they're reading. And this week, it was Westpac, wasn't it, Ben?
Yeah, so we still have a little bit of track to run before the next rate call, which will be in August 10th and 11th. But Westpac is basically sort of, it's held firm on its prediction for 2 more cash rate hikes this year, and sort of describe some of its thinking behind the decision. Westpac sort of said it's become a little bit more confident in its position that the RBA will lift the rate at the August meeting, despite signs that the economy might be slowing a little bit. What it's less certain, what Westpac is less certain about is what's going to happen next. I think Westpac is still saying September, another hike in September is its sort of base case scenario, but it could also see a case for that not happening. So Westpac's forecast is still for 2 more cash rate hikes this year. Whether that happens in September or not, they're not exactly sure. But it's basically, that leaves Westpac as the only major at the moment still sort of forecasting cash rate increases at the moment. I think the other 3 majors is sort of forecasting a bit of an extended hold until 2027. So
I think rates have peaked at 4.35.
Yeah.
Whereas Westpac's the kind of lone wolf.
Yeah. And I think now again, we've seen increased activity in the Strait of Hormuz again, and the conflict between Iran and the US has sort of picked back up again. So that might impact things if oil isn't able to get through as freely, and if inflation ticks back up, obviously that will change things. So there's always something to be keeping an eye on. But I think, it's really interesting to see that Westpac still says 2, and everyone else is like, nah, we're already at the peak cash rate.
The September one interested me because we've had swift responses, more or less, from the 3 other majors on those incoming data sets, whether it be inflation or jobs, really firmly reacting to it. Seen in NAB reversing their call completely to cuts eventually in about a year and a half.
Yeah.
So they're still sticking by their guts and instincts.
I'm sure it's a bit more than that. I'm sure it's also analysis.
I'm grossly oversimplifying it. But seeing the September one is more line ball. I kind of expected to hear that from Westpac just sooner. So, but at least they've come out and said it and transparent about it. Anything could happen. We say this every time we talk about it.
Yeah.
Anything.
It
could
is
happen.
a bit mind-boggling when you start following these the movement and sort of what the banks are saying, and it becomes almost as if they're interpreting interpretations of things, reading between the lines in RBA policy statements, and the RBA is looking for signals from the market, which the banks are leading. So it's very confusing.
It's a lot of cyclical kind of forecasting.
Yeah.
But I think the other thing that's really interesting is that if Westpac does think that there's another 2 hikes to come, does that mean that their fixed rate loans are 50 basis points higher than everybody else's, which I don't think they are at the moment. So they think that there's going to be 2 more hikes, but they're not yet pricing that into their loans. And obviously fixed rates have been moving a lot recently.
Yeah.
But I'm just interested to see that. I was a bit like, well, I'm surprised that their fixed rate isn't higher if they do think there's another 50 basis points to come, because you would think they would be wanting to put that into their product costings. Yeah. Whereas, I just don't think it is that far out from the other big 4. So obviously that tells me that competition is really playing a part here, that they're not wanting to increase their rates just yet because they want to get still some mortgage demand flowing through to them, because obviously that has been softening recently.
Yeah, it's been slowing down. So I think Westpac priced initially when they made this double hike prediction back in, I think it was March. And so I remember me and you talking about it, that, we've seen pricing movement from Westpac, but I don't think they went as far to price in that, as you were saying, full 50 basis. Because
if they think it's this year, you would think the 1 year fixed rate would be 50 basis point higher than everyone else's.
Yeah, and you've got other lenders now, like AMP, reducing their fixed rates even further. So kind of banking on an extended hold and eventual cuts.
Yep.
In about a year and a half time, who knows when. So I think, like you were saying, the lenders are going to take whatever they can get, especially when kind of sentiment and activity is so low, especially in the investor category. You're seeing a mix of first home buyer, anecdotal things of, brokers are telling me first home buyer applications are still holding steady. And then you see kind of mortgage data from Westpac that shows it decreasing. So I think it's in certain pockets and that kind of thing. But it's starting to chip away. So the lenders are really holding out for a hero here, if that makes sense.
Outside of that, though, we have got a lot coming up as well on the horizon. And I think this period, it's always towards sort of July, August. We have a lot of awards. We have a lot of conferences coming up. We opened our Commercial Finance Awards category submissions this week as well. If you are a commercial or finance broker, do put in a submission for Commercial Finance Awards, and then we'll be holding the ceremony for that in November, the end of November. So if you're a commercial asset finance broker, if you're a commercial mortgage broker, if you're a finance broker, if you're helping small businesses access credit and debt, then make sure you check them out, because lots of great categories. If you're listening to this and you know a commercial finance broker that you think deserves recognition, then do feel free to nominate them, and then our team will go and hit them up for their submission. It's always nice to see people being nominated, and lots of people do that. We'd love to see them as well. And you can find that all at commercialfinanceawards.com.au. Covered a lot of ground there again in the podcast, but if you've got any thoughts or stories that you'd like to share with us, do feel free to reach out. You can reach me, editor@theadvisor.com.au. Of course, Charlie and Ben as well. All of our email addresses are on the website. Or you can just leave a comment in the review for the podcast if you like this podcast. And we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.